I'm asking you to kind of open up your 4 decades of crystal ball and say, what do you see going forward? Will we see some relaxing? Because I see in this chart, there's some spikes and it drops up, but it never gets back down to that 3.6 level that was last week.
Well, it could, and I think going forward, the two things to really focus on in terms of financial markets and economic data points, it's going to be the inflation numbers and the labor market. So the excitement about the Fed is behind us. So nobody's thinking about the Fed because it's a ways off. The next Fed meeting is not till the day after the election. So now what comes to the forefront is from week to week, month to month, the economic data points that get released. In fact, I would tell some people, if you want, you can Google U.S. economic calendar, and you can pull up a schedule by day of the economic data points that are going to be released. And I use that all the time to kind of track what's going on. And so where we go from here is going to be all about the CPI and PPI, again, the consumer price index, inflation at a retail level, producer price index, inflation at a wholesale level. Part of the reason that the bond yield has creeped up already since the Fed announcement is some in the market, and I think more and more participants in the market are saying, wait a minute, we haven't, the inflation fight is not over. In fact, the most recent numbers show a little bit of a creep up in inflation numbers, not down. If that gets any worse, if we see, the CPI the next time it's released, the PPI or the Fed's favorite, the personal consumption expenditures index, PCE, if we see the next release of those numbers creep up a little, even a 0.1%, this yield could get worse, not better. So it's going to be very important in the next period of time to see what the CPI and PPI and PCE numbers do. We need to see those improve some more before you're going to see this bond yield get much better than where it is now. Same goes for the labor market. If we see labor numbers going forward, unemployment rate, number of new jobs added, claims, initial claims for unemployment benefits, if those numbers don't reflect going forward here in the next few periods, some more softening in the labor market, that's going to be another reason these yields are going to hold up and you're not going to see much improvement anytime soon. And so that's why that's another example of why don't focus on this one little event of the Fed tweaking this one overnight rate, overnight borrowing rate. There's much, much more to how these mortgage rates behave and what directions they go than just that one particular isolated decision. So